to keep in context, the Chinese market used to grow at 12%, at 9%, at 10% year on year. So we couldn't imagine that the Chinese economy would grow below 8% a year. And now it's growing at 5%. So on the one hand, the Chinese economy as a large economy still growing at a really reasonable rate for a large economy. But for companies who were used to China continuing to grow at double-digit rate, 5% is worrying. We didn't used to ask a question about, are you worried about the Chinese economy slowing down? Because everyone was here to capture the market that was the booming Chinese economy. And so we didn't used to have that as an option. We didn't used to say, are you worried about the Chinese economy slowing down? But that was starting to show up in other areas. And so this year we said, well, we better slide that in as an option. And to our great surprise, it was the number one choice.
Hi, everyone. I am Zongyuan Zoe Liu. I'm the Maurice R. Greenberg Senior Fellow for China Studies at the Council on Foreign Relations. Today, I have the special privilege to join Michael Hart for a special session to talk about a very interesting and important report, the 2026 China Business Climate Survey report. And we have the special privilege to be invited by the National Committee on U.S.-China Relationship. Before I get started, for our audience who might not be familiar with American Chamber of Commerce China, can you briefly explain AmCham's role in the U.S.-China business ecosystem, what it does for American business in China, and why this annual business climate survey matters for both companies and for policymakers in both countries?
Great. Thank you, Zoe, and thank you to the National Committee for putting this together. AmCham China is an organization based in Beijing. We cover all of China. We have about 800 member companies. And we say simply, it's our job to help our members succeed in China. So our 800 companies span all kinds of industries. We were originally founded in 1919, so we've been around a long time. We were gone for a while after World War II, but reestablished in 1981. We say that we do three things, A, B, C. A is advocacy and access, B is business networking, and C is community events. And for the past 45 years, since reestablishing in 1981, we've been the center of business, both to help them work together as China has opened, and also speak to the Chinese government and to the US government on behalf of our member companies. A couple of things that we do around advocacy. Every year we put together our China in Business white paper, so this Baipishu, which we take to both, again, the Chinese government and the US government to talk about specific issues that we have. And last year that was about 600 pages, English and Mandarin. The other major report we do is the BCS, the Business Climate Survey. And we've been doing it now for 28 years. And each year we ask a consistent set of questions to figure out what are the key concerns and opportunities of our member companies in China. And so it is watched, I think, with great anticipation each year. What are the main concerns of US companies and how are they doing? And so very happy to be sharing the 2026 BCS Business Climate Survey from AmCham China with you today.
Yeah, thank you very much, Michael, for the introduction. You have been leading AmCham China for quite a few years now. And me as a researcher, I personally find it very useful for my own research. I'm curious, what were the findings in this year's survey different or surprising from your point of view compared with previous years?
So one of the things that's interesting this year is that there's some optimism, some increase in optimism. A year ago, when we talked about the survey, it was very concerning. Less than half of our member companies reported being profitable or very profitable. A lot of them were sort of a break even, but this year, again, the companies have nudged back over profitability. So I think it's about 52% of companies are profitable or very profitable. So that's a good sign. As I like to say, no one goes to China to break even. And so it's important for our companies to be profitable. One of the things that's consistent is that companies continue to say China is an important market for them. A year ago, there was a big increase in companies saying that they were looking potentially to move manufacturing to other areas. But the truth is, solidly, most of our member companies who do manufacturing saying they're not going anywhere. So there's a combination of some new optimism. We called it the Busan bump because we did the survey at the end of 2025, right when the presidents were meeting in Busan. And as we'll probably talk about, U.S.-China relations are an important factor all throughout this report. So again, a little bit more optimism this year than last year, and a little bit more profitability this year than last.
I wanted to pick up on the sense of optimism there. And I think the report, Michael, frames resilience as a core theme for 2026. And from what you just told us and the numbers in the report, that both companies' revenue expectations are both up. So combined with the sense of optimism that you told us and the kind of resilience message, how do we interpret this? Does this mean it reflects genuine new growth opportunities in the Chinese market, or is kind of a recalibration by firms that have sort of adapted to prolonged uncertainty and risk, and companies sort of figure out a way how to do it?
Right. So I think our chairman in his chairman's letter did highlight resilience in the report, and it's interesting to see what people pull out of it. And I think one of the things for people who watch China closely will realize, but not everybody else does, is that the COVID lockdown in China for 3 years still continues to have a big impact. There was the business sentiment before COVID and post-COVID. One of the most important things is it feels like either because of geopolitics or because of the COVID lockdown or because of some tension between the US and China, global CEOs really reduced their visits to China. US government officials reduced their visits to China. And so if you're running a business in China these days, there's a couple of things that happen. Number one, you don't have the attention that you used to have from headquarters. The other thing that you have is more skepticism from the US government about why US companies should be in China. And you have skepticism from the Chinese government about why they should be working with US companies here. And so the member companies who answered the survey who are still here have been resilient for a whole host of reasons, but it's not easy to do business here. And again, we'll probably get into it, but there are some areas where US companies feel like they don't have fair access. And so when we have conversations with the Chinese government, we say, listen, you want investment, but for companies to make investment, they need to feel confident about this market. So to your question, in some ways, as the Chinese market has changed rapidly, our member companies have had to pivot. So in some ways, they're looking at opportunities from the old business model, but in other ways, they've had to pivot. And so, Zoe, I know that you know, but if you just look at the last 5 years in China, a number of things like electric vehicles have really boomed in China with more than 100 new Chinese companies doing it. So if you are a traditional American or European automaker, this market has moved massively. China has digitized payments. China has all kinds of new market entrants in everything from retail to coffee to services. And so our member companies have had to pivot, and they're still here, and many of them now for 20, 30, 40 years. But the challenges they have now and the opportunities look very different than they did even just a few years ago.
You were alluding to the China speed. Some people allude to that as Shenzhen speed. And I believe that a lot of the American companies who have been operating in China, they never left, means they have figured it out a way. So with this year, China is going to do its new 5-year plan with tariffs, and with the new business survey. What changes? Where are the new areas companies are investing, more optimistic business opportunities? And do we see companies seemingly herd into a set of narrowing preferred sectors because the 5-year plans seems to set strategic prioritized sectors?
So there's a couple of areas of opportunity. I mean, one of them, you talked about the China speed. And when we talk to folks in the United States, when we talk about the importance of US companies being in China, part of it is because of the innovation and the speed of things that are happening here. If companies want to be relevant globally, they need to know what's happening in China, of course, the world's second largest economy, and probably soon to be the world's largest economy. And when people ask, shouldn't our companies leave and reinvest in the United States? I mean, our member companies are happy for their companies to invest in the United States, but they certainly want to be in the most dynamic and one of the fastest growing large economies in the world. So in terms of a couple new opportunities, one of them is healthcare. So as China gets richer, it wants more healthcare. As China gets older, it needs more healthcare. And we believe that U.S. companies and foreign companies have some of the best healthcare, whether it be medical devices like surgical devices, or whether it be pharmaceuticals, or they have long experience in services related to medicine. And so we want to see them be able to sell into this market. A couple of other things are China going global. So Chinese companies who are looking to global markets, and a number of our companies in the service sector, like those who do legal services or accounting services that used to help foreign companies enter China, they're now helping Chinese companies go global. And so it's a whole market that probably nobody thought about 5 years ago. And so that has created an opportunity for our member companies here.
That's a great segue for me to ask you another question related to the service sector. And in this year's Business Climate Survey, there is an interesting divergence in the data, which you already alluded to, which is the service sector is performing strongly and expected profitability over 60%. And growth expectations for tech R&D sector have somewhat weakened. So why is this? Why is the service sector outperforming tech so significantly, despite, here in the US, everybody seems to be buying into, whether you like it or whether you believe it or not, the tech AI bubble, but seemingly tech operation in China, not necessarily so.
Right. Well, the services we touched on a little bit, but to put a finer point on it, with Chinese companies going global, they actually want foreign expertise. That's one. Two, there were some service sector companies that closed, so a number of U.S. law firms closed. And so what we believe is those who remained have seen their profitability grow. So that's gaining market share. The tech is an interesting comparison, and it does bring in the U.S.-China challenge. One, the U.S. has limited certain types of technology, the most advanced technology, from being sold into China. At the same time, there are Chinese tech companies competing in many areas. And then you have a little bit of local protectionism where some Chinese buyers would say, well, if the US had said you can't buy the most advanced technology from the US, why should we buy second tier and put it in our products? Because if the US decides to be more aggressive and to limit US companies from exporting, then we'll be in trouble if we relied on US tech. And so tech companies are being squeezed from both directions. They want to sell onto this market, and some of them, for example, supply both, let's say, Chinese handset makers, phones, and EVs. So there's a lot of places where for Chinese products, there is US tech in it, but US companies who want to sell sometimes are meeting this sort of fear from Chinese companies that say, well, we're not sure that you are a dependable supplier. And so for years and years, US tech was the best and the most dependable. And now they may not be alone in terms of innovating, but also they may not be able to sell here. And so tech is being squeezed in both directions.
Talking about tech being squeezed in between, then this is an opportunity for me to ask you something less optimistic. And now I wanted to switch to sort of, what are the business challenges that you find in this year's business survey? For me, I find it's interesting that for 5 consecutive years, U.S.-China relationship was the top challenge, but this year it has been displaced by slowing Chinese economy, cited by 64% of respondents. For me, as somebody who studied this subject, I find this is interesting. So what does this shift indicate?
So it's interesting, and I should say we have to put a little bit of a star or an asterisk there, because for the past 28 years, we've done the survey. And if you think about it, when we talked about what are the problems and challenges companies have, we didn't used to ask a question about, are you worried about the Chinese economy slowing down? Because everyone was here to capture the market that was the booming Chinese economy. And so we didn't used to have that as an option. We didn't used to say, are you worried about the Chinese economy slowing down? But that was starting to show up in other areas. And so this year we said, well, we better slide that in as an option. And to our great surprise, it was the number one choice. So clearly it has been a pain point for people. Now, again, to keep in context, the Chinese market used to grow at 12%, at 9%, at 10% year on year. And I remember 15 years ago when I was running a US corporate, my boss asked the economist, now, why does the Chinese economy have to grow at 8%? Why is that? And we were talking about, because of the number of jobs it needs to create. So we couldn't imagine that the Chinese economy would grow below 8% a year, and now it's growing at 5%. So on the one hand, the Chinese economy as a large economy still growing at a really reasonable rate for a large economy, but for companies who were used to China continuing to grow at double-digit rate, 5% is worrying. The other thing, and I think that's why it jumped up there at the top of the charts the first year that we asked that question. You did mention U.S.-China relations. That has been a concern for the past 5 years. It still comes up as number 2. A couple of other things that we see in the macro and then by sector data is concern with competition from Chinese companies, whether those be SOEs or private companies. And there's also some concern about the markets being oversupplied with competition.
And what you just mentioned, the intense and fierce competition from both state and especially private companies in China allude to a phenomenon that economists or now Chinese leaders also recognize, which is industrial overcapacity. So for American companies operating in China, how is the overcapacity challenge specifically impacting pricing power and profit margins? Is this viewed as a short-term phenomenon, or is this a structural and a long-term concern?
It appears in a couple areas. I mean, the first thing I think to keep in mind that in many ways, China has a very closed capital market. So there's a lot of money in China looking for opportunities. And I remember a few years ago speaking to someone who was in the a mining and refining business. It was an American company. And the boss, the CEO, told me that they were making really good profits in China. And when other Chinese companies saw how much money they were making, everybody piled into the sector. And so very quickly, they saw their margins decline. So that's one example. The other, if you look at heavy equipment makers, so people who make construction equipment or farming equipment, the construction market has slowed with the Chinese real estate market slowing. And so what happened was U.S. companies who used to lead in many of these sectors, they found they had a Chinese competitor. Now, let's say if the Chinese competitor makes something at 80% of the quality, but at 50% of the price, then very quickly you're undercut. And people would say, well, why should I pay more for a product that's about the same? So some of these equipment manufacturers who came to China to build in China and sell in China, they've had to completely change their strategy. They still build in their Chinese factories, but now they export all of the products to the developing market. And so they certainly have had to pivot. And many companies have seen this. We've had companies who do retail who've had to pivot because they had solid margins, but then all of a sudden these Chinese entrants who will come in at a low price to try to build market share. And so China is just one of the most competitive markets in so many sectors that companies have to stay on their toes. A friend of mine talks about China as a fitness center for companies for the world. So you need to be here to work out to make sure you're lean. And if you are, you can probably take those lessons and expand them out into your global network.
So if you can make it in China, you can make it anywhere.
Now, I think that's right.
I wanted to follow up on your mentioning of U.S.-China's relationship continuing to be the second most significant challenge or concerns for American business operating in China. But this seems to sort of put this in the bigger context of what you just mentioned, right? Sentiment around U.S.-China relationship has improved, which has triggered a sense of optimism since President Xi Jinping and President Putin's meeting in Busan in 2025. So from your perspective, being an executive leading AmCham in China, from your conversation with American business, what's really driving this shift in the business confidence? Are CEOs, are companies responding to concrete policy changes, or are they simply sort of reacting to this short-term, very, very fragile in some way, high-level communication channels? Do members feel that there is already a floor to this relationship? We've seen the worst, or again, this is something still need to be worried about?
So I just attended one company event last week, and they told me that volatility is the new normal. And so I think in some ways you have companies who have learned a lot about how the relationship has changed, and they say, like, look, we just need to be ready for volatility. We just need to be ready for the ups and downs. And so getting better at managing that means that you are ready for the sort of the new normal. If you take a look at the last 3 US presidencies, so Trump won, he introduced a number of tariffs. Then when President Biden came in, the Chinese initially thought that he would take those tariffs away, but he didn't. And in fact, he introduced a number of more concerns with China in terms of, there are economic concerns that now become national security concerns. So there was a lot more discussion about national security. And so it still was not easy to be a US company here. We go back to about a year ago when President came in for his second term. And of course, he started a global trade war by increasing tariffs. And then pretty quickly thereafter, China escalated by putting restrictions on rare earths. And so for the last year, it's really been up and down and just very challenging. And so when we were doing the survey this year, there was a sense of somewhat calm from October through November. And then as the leaders were meeting in Busan, it did make people think, okay, we've finally gone through a lot of volatility and things are a little bit better. If we lay over that the year before, when we had done the survey, it was right during the US presidential election. And if you remember, the Democrats and the Republicans were beating up on China. So China, of course, is everyone's a China hawk in Washington, D.C. these days. So from an election where everyone was concerned about China to this past year where the Busan meeting was taking place, it did give people a little bit of sense of optimism that hopefully that we had hit a floor. The other thing that I think we saw in 2025 was that both the US and China, by putting extreme restrictions on each other's trade, I think they also realized that they need each other. US farmers need to sell soybeans to China. China needs still technology from the US, and they're both very important trading partners for the other. And I think we hope, the business folks in China hope that US and China learned that in 2025.
That is a very interesting lesson that I hope the Trump administration would listen. Now, if I can sort of follow up just on that point, what does the business want from the U.S. government? One of what I picked up in the report is that when asked what the U.S. government could do to help, and I quote, refraining from aggressive rhetorics tops the list. So what does this mean? Does that mean like business community is signaling to Washington that you can do whatever you want, but just do not say aggressive things? Or they would prefer cooling, stability, and a more friendly and calming policies?
Yeah, I think, politics certainly are day by day and week by week. But there has been a lot of rhetoric back and forth. And again, from 2025 as the example, tariffs went up as high as 100% or more, and then have come back down to whatever 20 or 30%, depending on your sector. What businesses need is long-term planning. And you can't make a plan if you don't know what the rules will be. And that was a concern in technology specifically. Companies would say, listen, tell us what the rules are, tell us what we can sell to China, and we'll sell that. But we do need to have clear, transparent rules so that we can make investments. And to be honest, this is true for both the US government and the Chinese government. What member companies want is a level of transparency so they can make long-term plans. And again, our member companies who are active in China are consistent in their belief that we gain by trading with each other, and that the two largest economies in the world who are already intertwined are not going to separate or fully decouple anytime soon. And so what we need is cool heads and transparency and the ability to plan long term.
So on decoupling, Michael, oftentimes people see decoupling from, broadly speaking, two perspectives. So one is to what extent capital is leaving China, is not coming back. And then the other perspective is manufacturing sector and companies leave and relocate. Now, from these two perspectives, at least in the data presented in this year's business climate survey, it doesn't seem to suggest that there is a massive exodus of capital leaving China. What does that mean about American companies' approach towards its investment in China? Are there new investments coming in, or is this mostly reinvestment of existing profit?
Yeah, so I spent 20 years in China doing commercial real estate, and part of that was helping companies set up operations in China, everything from bank branches to factories. And so, one of the things that happens is when you sign a lease in China for to build a factory, you're normally there for 20 to 25 years in that term. And so, what that means is if you have a bad year or two, you don't pick up and close and move your operations out of China. So you think about things in decades long plans. And so, we do ask the question, are you planning to move manufacturing out of China? The vast majority of companies, as you stated, said, no, we're not planning to move operations outside of China. Although there has been an increase in companies say we're starting to look. Now, my interpretation of that is COVID taught us a lot of lessons. And one of them was you don't want a single point of pressure in your supply chain or your manufacturing. And so what we're starting to see is some companies who say they're looking at other markets, they're not necessarily closing the China operation to open one in Vietnam or India, but they may be supplementing their global supply chain to say China continues to produce for us at the best price, the most dependable way, and continues to innovate. But we or our suppliers do want to make sure that we have a backup plan if something happens in China again or globally or with US-China relations. And so that's one of the places that we see some additional investment. Now, I would caution, in fact, when I go to Washington, D.C. next time, that, again, I think U.S. companies need to continue to play in this very large market. And so we do need to see companies continue to invest here, number one, just to maintain the market share they have. But we also ask a question in the report about how important is innovation in China to your business. 90-some% of companies say innovation is important. And so, again, I think that right now, the literacy level on China in the United States is not as high as it should be. I think that the US is suffering from not having enough corporate global CEOs coming to China, enough not having US administration officials coming. And of course, think tankers and students have also fallen off. And so I think people need to realize that you have to continue to invest to keep your market share in this market where innovation is really critical. And, even if you're losing, you need to know why you're losing, because if you lose the China market, frankly, you will eventually lose the global market. And so, one of the things that I want people to think about is if US companies were to leave China, what would that look like in 10 years? And what that probably would mean is that US companies would lose market share globally because they wouldn't be competitive in this very important, very innovative market.
To pick up on that, Michael, I just cannot agree with you more in terms of the need for top-level policymaker in Washington, D.C. to have updated China knowledge. I think a lot of people's understanding about China is still that China steals foreign technology without recognizing that in some sectors, China's innovation is actually quite world-class and leads the sector. Now I wanted to sort of move specifically into some of the interesting findings in the report with regards to regulatory barriers. The report reviewed what I consider as a nuance. About 64% of companies felt that they have received equal treatment to domestic companies within their study, yet 55% still report unfair treatment regarding market access. So what does this entry barrier or market access mean? Like why it remains such a prominent hurdle, despite a lot of people like you have been trying to help American companies get to the level playing field?
Yeah, it is a sort of a two-step question, but it is also related. So on the one hand, foreign companies do feel like they can set up here, they can hire. They used to be discriminated against in a number of ways. And I think generally they think, okay, this is in most cases a fair marketplace to set up a business and to operate. But if you're doing government procurement, and I mentioned healthcare earlier, so healthcare companies, when they sell to hospitals, that's government procurement because most hospitals, for example, are controlled by some government entity. And in many cases, they feel like there is a preference for local players. And so they're like, wait a minute, we have the best product. Why can't we sell into this market? There was a period of time in the last couple of years where there seemed to be a preference for locally made products. And then there was some confusion about, wait, what is domestically made? And so a number of US companies would say, well, wait a minute, we make this product in Chengdu, or we make this product in Sichuan. why isn't it considered a local product? Because it was made by, Chinese workers. And so this made a number of those people in government procurement do a bit of a double take and go, well, wait a minute. Oh, we hadn't thought about that before. We thought because the brand name was foreign, that it must be foreign made. So that was one. The other thing is, of course, you will know that in China, you've got a national level policy, but then you have a regional level, like at a provincial level, or even further down a city or district level implementation. And in various provinces, there are sort of local players. And so people want their local companies to succeed. And sometimes, although at a national level, you may be told that you have fair access, if you try to sell in a particular province where they might have a local champion, you might be squeezed out. There are similar concerns in technology. And so, for example, the big four banks, the state-owned banks, they used to use a lot of foreign technology, whether that be mainframes or software systems. And there's a feeling that they've been squeezed out. Now, I've been in a number of discussions with Ministry of Commerce and Ministry of Finance where they say, in fact, no, this is not true. But our member companies do feel that this has happened. And one of the jobs of the American Chamber of Commerce in China is to take the feedback from our companies and to have an ongoing dialogue with both MOFCOM and Ministry of Finance so they understand where companies feel like they're being squeezed out.
So let me just pick up on the policy and the policymakers' point you just alluded to. If policymakers in Washington and in Beijing could just take one lesson from this year's business climate survey, what that lesson should be?
I mean, I think our member companies want fair access and fair treatment. I think, and again, you will know, I often call China the most competitive market in the world or the most capitalistic market in the world. I mean, competition here is really fierce. And so our member companies want a fair shot. What I like to tell the Chinese government, it's often easy for my job to represent American companies because I believe our companies do business in the right way. They treat their employees well, they pay their social taxes, and they're really good corporate citizens. And if they feel like they're being squeezed out of this market, if they do exit long term, that will be a loss to Chinese workers and to the Chinese economy. And so, again, we want fair access and fair treatment. We want to be able to sell our products here. And that means, making sure that Washington is clear about what can be sold and making sure that the Chinese government will allow those things to be sold in a fair competition.
All right. With that, thank you, Michael, for spending your evening with us. And many thanks to the National Committee on U.S.-China Relationship for inviting us to share this year's Business Climate Survey. And congratulations, Michael, for the release of the report.
Thank you. And I think AmCham China has the Business Climate Survey on our website. We would welcome people to take a closer look, but thank you very much.